Welcome to the Daily Coin. My name is Rory, and today is Friday, November the 27th, 2015, and I have the distinct honor and great pleasure of welcoming back Mr. Jeff Nielson, who is the publisher of the bullionbullscanada.com, all the great commentary you can find over there. And he has a lot of investor ideas as well that he shares with people. And he also is a writer for SprottMoney.com. Jeff, how you doing today?
Doing fine, and it's always a pleasure to hook up with you with these chats.
Same here. Well, we've got a lot to cover, so let's just jump right in. What do you say?
Sounds great.
And you have penned a piece that ties in Steve St. Angelo over at SRS Rocco. You tie in his work with your analysis, which is really great. And Steve St. Angelo's only gone back 12 years, and you've added an additional 18 years. And I was reading the article this morning, and I see this chart that you've got in here of silver inventories at low levels, and around 97, 98 to 2004, silver just took a freaking nosedive. I mean,
actually, that dates all the way back to 1990. It was a
1990. Okay,
15-year slide. Yeah, numbers are a little hard to see off that, but it was a 15-year slide. 90% collapse in inventories over that 15-year period.
90% collapse.
Yeah.
So where are we? As far as that 90% collapse, where are we at today? You're saying that we've not recovered from that?
No, based on inventory levels that existed, 10, 15 years ago, we're way below zero. So this becomes the question is, why has there not been a default when going back to 2005, the world was basically out of silver. And at the rate that inventories were being depleted at that time, we would have expected the silver market to default in 2007. And of course, since that time, for many years after that, the bankers were pretending that the silver market was in surplus, that inventories were being rebuilt. And of course, that's why I addressed that little hook you see at the bottom of that chart where supposedly things had turned around. But in fact, that never happened because that was the time when the bankers introduced their so-called bullion ETFs into the market, which were just, the particularly fraudulent version of their paper called gold and paper called silver. And one of the aspects of this fraud was that they engaged in the ludicrous accounting practice of adding to inventories every time someone purchased gold or silver in these bullion ETFs. And of course, this is total perversity. In the real world, if you walk into a bullion dealer and you buy an ounce of silver, that dealer's inventories go down. Of course, if you go into a grocery store and buy an apple, the inventory of apples go down. But in the fantasy world of paper called gold and paper called silver, when somebody buys a unit of these funds and a quote unquote ounce of gold or silver, inventories go up.
It's like magic.
Yeah, it's kind of like accounting Rumpelstiltskin, where they just treat sales of bullion as if they were purchases of bullion. In terms of the inventories themselves, or sorry, they treat a drawdown in inventory as if it was a build of inventories. Absolute perversity. Not only do they not account for the silver and gold that's being purchased when these investors purchase their units of these ETFs, but they actually march the inventories in the opposite direction. It's pure insanity, and it's just one of the aspects of insanity of the record keeping of these criminals. Part of the reason that I was really grateful for the article by Steve St. Angelo is because I was having a hard time filling in the gap between that chart you just mentioned that goes through to 2005 rather, and the years in between when the bankers had previously been pretending that the market was in surplus. And then of course, Steve came across this data indicating from the criminals themselves that now they've revised their data and acknowledged that the silver market has been in deficit all the years since then. So that for me that filled in the gap really nicely, and then allowed me to extend this all the way back for a full 30 years.
which is pretty remarkable. I mean, so this goes back to the question that I like to ask everybody, and I've been asking for close to 3 years now. Where is the silver coming from? I mean, if it's been in deficit and mining supplies are all of the low hanging fruit is gone. They've been high grading their mines for the past at least 2 years, minimum of 2 years, if not much longer than that. So, as far as silver coming out of the mine and onto the market, that's being gobbled up as soon as it's dug up out of the ground, from all indications. I mean, according to the numbers anyway. So, where's the 300 million or 200 million ounces for investment? Where's that coming from?
Well, excuse me. I think I've probably mentioned my own working theory in the past, and that's that there's a quote unquote secret stockpile. And this is just based on the old Holmesian logic that when you eliminate the impossible, whatever remains, no matter how improbable, must be the answer. And going back to what I was saying before, the data clearly indicated that the silver market was headed toward a default in 2007. By my rough estimates, there's been a depletion of somewhere around another billion ounces of silver since that time. So that's the question: where did that billion ounces of silver come from?
Exactly, man.
And there's simply there's no other answer out there that I've been able to see in all of the years I've been writing on this subject. And so, like I say, you eliminate everything else, and what remains is some sort of secret stockpile, which the banking crime syndicate has been bleeding off of, for the last 30 years. And of course, this is the thing that's so absurd. I challenge any of your audience or my audience to find any other market for any commodity where there's been a supply deficit for 30 years. Of course,
and then prove and then show where the supply is actually coming from, because that's the key. I mean, yes, it's been in deficit. We've known that. I mean, what your article is doing and what Steve St. Angelo has done is that you're showing that it's going back 30 years that we've been in deficit. So that means for 30 years we've been pulling silver from somewhere, and as you know, it doesn't come off the printing press like the U.S. dollars do. It doesn't happen that way. You have to have a physical piece of material in order for that to go into market, and it just doesn't make any sense. So the challenge is show another commodity that's been in a 30-year deficit, and then show where the excess is coming from, because that's the only thing that I'm concerned with, is where is it coming from, because and then showing that will expose the fraud completely. Will expose the hand.
And of course, most of our other commodity markets have relatively greater transparency. And so, for instance, we could look at the wheat market, and we know what sort of stockpiles are in existence, for global wheat supplies, and you could crunch the numbers any way you want. There's no way that the global wheat market could sustain a 30-year drawdown in inventories without the world wheat supply being totally exhausted. And same goes for coal or lumber or whatever. There simply are not sufficient stockpiles of any commodity to withstand 30 consecutive years of drawdowns of inventories. And of course, what makes precious metals so much different from these other commodities is the fact that they are quote unquote precious, and thus people tend to conserve and hoard them. And thus, people don't hang on to, supplies of coal, in their garage or timber or that, but they will of course hang on to gold and silver. And so this creates the potential for stockpiles. But beyond that, of course, if we dig back in history, what much of your own audience may not have heard before is the fiction regarding the Great Depression. And the mythology was that the Wall Street engineered crash of '29 was the cause of a global depression. And of course, this is total nonsense because back at that time, markets were such a small part of our overall economies in comparison to today, where the markets are many, many times larger than the economies they supposedly represent. And so back in those days, the idea that a single stock market crash could trigger a global depression was ludicrous. What actually had happened was going back a full decade prior to that, after the end of World War One, the Western powers, at the urge, well, basically Britain, at the urging of its banker overlords, looted all the silver out of India.
Yep.
And they did this because as a result of World War One, India had amassed enormous quantities of silver because Indian soldiers would not fight for Britain unless they were paid in silver. And so the British Empire was able to field, a large contingents of Indians, fighting for them, but they were all being paid in silver, and that consumed a lot of silver. So by the end of World War One, India had amassed, even more silver, and of course, it's always been a nation that's treasured precious metals. And so the bankers simply decided to loot all the silver from India, and of course, looting all the silver out of that economy crashed India's economy. But then they took the silver that they had looted from India and they dumped it onto the global market. And problem with doing that, of course, naturally it crashed the silver market. But at that point in time, China's economy had an official silver monetary standard.
Right.
So when they looted the silver out of India and dumped it onto the market, they destroyed China's monetary system. And of course, that sent China into a depression. So, through this one act of economic terrorism, the West managed to create severe depressions in the world's two largest populations. And of course, if you create severe depressions in the world's two largest populations, that can very easily mushroom into a global depression. And that was the real cause of the Great Depression. The crash of Wall Street was ultimately a consequence of the destruction of India's and China's economy, not the cause itself of the depression. And so this traces back, this could be, of course, the initial stockpile that we're talking about today that they're still bleeding off of. And of course, there was silver confiscation in the U.S. in 1934. So, this secret stockpile that I'm postulating could be something that the oligarchs have been hanging on to for a very, very long time.
Well, and unfortunately, I don't know how we're going to be able to prove that, but it's the only thing, like you said, once you eliminate the logical, then you're only left with what you can speculate on. And
yeah, you eliminate all other possibilities, and when there's one possibility remaining, it must be the answer. And so, if there are any other theories out there, I welcome readers or other commentators to pass them along. But there certainly doesn't seem to be any other possibility here. And of course, now, thanks to the numbers that Steve St. Angelo have come out with and the chronology I put together here, our audience can see for themselves. So there's simply no explanation for this market. The naked fraud is out there. It's the market could not have continued to exist given the parameters we were given. It has continued to function, so there must be some other source of supply being pled onto the market.
And as I just mentioned a moment ago, Jeff, everyone is aware in the audience, or a lot of people in the audience are aware of what's going on in the mining industry for the past 4 years with the exchange rate suppression that they've had on the markets as far as gold and silver. They reached their nominal highs back in 2012 or 2011, and since then it's been downhill, and that has a direct impact on the miners and their ability to raise capital. And this is a very capital intensive situation where the miners and the mining operations have to have a constant influx of cash, period, and they haven't had that. So how do we move forward from here as far as being able to maintain this fraud, being able to maintain the supplies on the market, and this whole charade. I mean, they after 30 years, you would think that their supplies are running thin. I mean, is that part of what we're seeing as far as just this blatant criminality and in your face price suppressions?
Well, I think it's very important that everyone realize that there are some fairly significant distinctions between the gold market and the silver market, and between gold mining and silver mining. And it is all a function of price. Of course, I'm sure most of your audience is aware of that for most of the last 5,000 years, the uh, normal and almost fixed price ratio between gold and silver has been roughly 15 to 1. And of course, this is perfectly normal and expected because in the Earth's crust, gold and silver exist in approximately a 17 to 1 ratio. So, historically, we've had a price ratio which has simply reflected the supply ratio. And then, of course, over the past near century now, going back to when the bankers, launched their economic terrorism 100 years ago with the looting of India's silver, that they created this massive disconnect in this historic price ratio. And since that point in time, we've seen insane price ratios between gold and silver ranging up to literally more than 100 to 1 at various times.
Yep.
And of course, today we have the insane ratio of approximately 70 to 1. Yeah, the price ratio is extremely skewed to, in terms of silver being much more depressed. And of course, this is reflected in the miners. Going back to the early 1980s, after the big spike in the price of gold and silver, when both metals were crashed, of course, silver was crashed much worse, to the point where, as I indicated in that second chart, in real dollars, it was taken to a 600-year low. And so what that did is that totally devastated the silver mining industry. Even so, when both metals were crashed, both mining industries were devastated, but the silver industry to a much greater extent. And literally to the point that the silver mining industry almost ceased to exist. For 4,000 years, most of the world's silver has been produced through primary silver mining, silver mines. And this, of course, is how we get almost all of our metals, through primary mining. You get gold through gold mines, you get copper through copper mines, you get silver through silver mines. But since the bankers crashed the price of silver to the 600-year low, they destroyed the entire silver mining industry. And in the 30 plus years since that time, the world has been getting most of its silver indirectly as byproducts of other mining. So this is the dynamic we're dealing with. There are only relatively a handful of companies that are officially silver mines, quote unquote.
Right.
And those companies are companies which have really high-grade ore deposits in historic terms. Thus, the only companies that can still mine silver and call themselves silver mines are companies operating the richest ore deposits that still are in existence. Conversely, because gold was not quite as badly devastated as silver, a smaller gold mining industry still remained. Most of the world's gold still comes from gold mines. So it's for this sort of paradoxical reason that we're actually seeing a lot more pain in the gold mining industry right now, because there were still a lot of companies remaining in existence as gold mines that were operating with medium grades, or in some cases even lower grade deposits, but they were still able to eke out an existence at previously depressed prices. And now, of course, with gold being stomped on for the last 4 years and just held down, those companies are now in severe distress, and many have already been forced into liquidation. Some have been bought out by other companies, and there will be more carnage in the gold mining side. The silver mining side is not suffering nearly the same sort of stress right now, simply because there are so few companies in existence that were even able to try to build themselves into silver mining companies. So there is a real dichotomy there in the mining side between the gold mining industry, where there's extreme pain right now, and the silver mining industry, which is relatively calm simply because there's no more companies to victimize.
But I thought that I've been under the impression that most of the silver that's mined is a byproduct of zinc or copper or lead mining, and they run into these veins of silver that exist within those mines, and that becomes part of their revenue stream, and that's where a majority of the silver comes from, or is that not right?
No, that's correct, and that's exactly the point. 70 to 80% of the world's silver has been coming as byproducts from other mining for the last 30 years, and of course, because of that, that production is not affected by the current price of silver. You know,
Right.
these copper mines are going to mine copper regardless, and whatever they produce in terms of silver is a bonus. But here's the other thing that's kind of perverse about this whole scenario. Uh, as I've also mentioned in this commentary, I previously came up with a rational price for silver today of $1,000 an ounce, and I think that's easily supportable in objective terms. Now, here's the point: if silver was priced at $1,000 an ounce today, a lot of these mines, which we call lead zinc mines, quote unquote, or copper mines, quote unquote, or even gold mines, quote unquote, would suddenly become silver mines because the quote silver credits that they were getting from their mining would suddenly be worth more than all of their other metal production if you increase the price of silver by 70 times, which is what the difference is between $15 and $1,000. So, you know, you take a lot of these companies' mining revenues, and if you multiply their silver revenue by 70, they would become silver mines tomorrow.
Yes.
So you know, when I talk about all of the silver mines having been destroyed, that's a slight fiction, because what happened was some of those silver mines essentially morphed into copper mines or lead zinc mines. There was still ore that could be marketed at a profit, but it was no longer primarily silver which drove the mine, but other metals.
I got you, and that actually makes sense. That because who wants to buy a silver mine when I can buy a copper mine? Okay,
And of course, if we
that's
ever get back to a rational price for silver, within a few years after that, once again, we'll have most of the world's silver officially produced from silver mines.
now that picture just got a lot clearer, and I appreciate you clearing that up for me because that makes perfect sense.
Well, it's, you know, it's one of these things where we've been living in this surreal world where the bankers have been treating this situation in the silver market as if it's somehow normal, that it's normal for the world silver supply to be produced in copper mines and lead zinc mines and gold mines. And of course, it's totally insane. But, you know, if you live your whole life in insanity, insanity starts to look normal. And so it's necessary to kind of step back and remind people this is how the mining industry should look in a normal world.
Yes, I mean, do you ever think that these criminals, is the free market strong enough at this point to overtake the algorithms and the HFT machines? Are there enough people to overwhelm them at this point, in your opinion, and based on your analysis?
No, not even close, because it's simply a matter of volume. Roughly 75% of all trading now is coming from these computer algorithms. So they just drown out all human trading with brute force. And then, of course, the algorithms are driven by data, and the criminals control the data.
Right.
So, you know, this is the whole point: is you have what are supposed to be free and open markets, but you actually have a closed system, because you have the markets being marched up and down by a computer program, and the computer program is based upon doctored data. So, you know, this is the point. Like, calling what we have markets is perverse. They're not
Right.
markets.
They're not.
They're simply exchanges that are totally rigged and manipulated. And that's not a market. A market is a meeting place where humans engage in commerce. And of course, it's based upon the premise of you know, free and open trading. Well, of course, it's not free and open trading, and it's not being done by humans. You know, so calling what we have markets is a total perversion of language. We
So
don't have markets. We have rigged casinos, totally rigged casinos, where you know, the criminals are totally above the law, and even to the point where, you know, if we look at so-called underground casinos, you know, even these quasi-legitimate institutions, they have to operate according to certain rules. And one of the basic rules is when the house loses on one of their bets, they have to pay off. You know, even in an underground casino, nobody's going to come there if the house doesn't pay when they lose.
right.
But in the bankers' world of fraud, you know, when they lose in one of their big bets, they simply don't pay. So, you know, this is the whole point here. We have commerce that has been totally perverted and totally criminalized in every respect, and yet the bankers continue to attach these old labels to their organized crime and call what they're doing business.
And you're right. It's nothing more than organized crime on a global scale. I mean, and it's disgusting. So, if I understand correctly, what you just said is that it's going to be either impossible or pretty darn close to impossible for us to get out of this current mess as far as the gold and silver market or the gold and silver situation. I'm not even going to call it a market. That's a disgrace to markets. Well, thank you so much for listening. And that concludes part one of this in depth conversation with Jeff Nielson. And if you'll click the screen right where it says to, that'll take you right to part two. And thank you very much for tuning in.